Hey guys, thank you all for joining today. I'm Eric Bramlett. I'm with Bramlett Partners, and today Aaron Scrugs with Agent Intel is joining us, and we're going to discuss the Austin real estate market statistics, greater metro area. We're going to talk about some national trends and indicators as it pertains to the local metro area. But first, I wanted to introduce Aaron and talk about why he is such an expert on this topic. Aaron, tell us who you are, tell us what you do, and why you're so dang good with statistics.
Hey, well, you covered a good bit of it. I'm Aaron Scruggs, founder of a market stats tool exclusively for agents called Agent Intel. I started it here in Austin back at the beginning of last year, so I've been tracking market stats for Austin longer than any of the other markets we're in. And yeah, some interesting stuff went on last month, so excited to dig in.
Yeah, I mean, at a high, I know we're going to really dig into charts and stats and just get into the weeds with this, which is why I love chatting with you about it. But, at a high level, if you were to describe what's going on in Central Texas, what do the leading indicators look like? You're talking to somebody, you're in an elevator with them. What do you say?
Sellers finally did what it took to get their home sold last month, and buyers finally stopped kicking the tires and finally decided to write offers. Pendings are up across the board, which is great. Typically, you see them go down in July, and they actually went up over the last month in all of the different ways of carving up the metro market, except for new construction. That stayed steady, and that tells me that sellers just started doing what they needed to do.
That's great. And that's interesting because you and I didn't do a lot of prep for this at all, almost none. And and I actually have a few charts that I glommed together in Google Sheets comparing the resale market to the new construction market. A lot of people that watch the show are in the industry, they're real estate agents or they're mortgage. And the new construction market doesn't do a whole lot for us, and the resale market is where we operate primarily. So I think it's interesting to dig into those details. Yeah, neat that you were looking at that, and I was looking at that, and we weren't really even talking about it. Anything else? If you're somebody, you're in the elevator and it's still going, and they say, okay, well, okay, that's interesting. What else did you notice?
In the prep we did, I was like, hey, I know one thing, and outside of that, that was the big and most noteworthy thing. Typically, July is when things slow down. And I know we're recording this in August. We talk at the prior month's numbers because it takes quite a while for those numbers to settle, for everything to get reported. So now is a time where we can speak about July with confidence.
Yeah.
And yeah, it is all about pendings going up when they typically go down. Usually July is when things slow down, and there's a lot of happy agents out there right now.
Awesome. That's great to hear. Can't wait to dig into the actual numbers. Before we go to the most recent numbers, I want to start by kind of showing what is specifically depressing our market it's not reported in the news. And it's the job market here. Anecdotally, we don't have any relos. I wish we had a way to track that, to show the number of actual relocation buyers and sellers that we have in any given time period, but there's no way to track that. I know because we've always done, as a brokerage at Bramlett Partners, we've always done a very high volume of inbound relocations, simply because we have a pretty big web presence. And that's if I'm guessing, it's probably down 90%. And it's been that way since 2022 when the market shifted. So I'll go ahead and share screen, and I want to show two reports. So the first chart is it's Indeed.com job postings, and that's January 2022 to present. And I like to zoom out because it really tells the story. We had a really great job market like we always have had. And then whenever the Fed started tightening rates, it affects more than just mortgages. It also affects businesses, how much they spend. And there was also a lot of hiring done during the pandemic. You could say it was irrationally exuberant, the amount of hiring that was done in the pandemic. The job market was way too heated. And it's been in correction for a couple of years now. And you can see that since about November of 23, the job market has just been bouncing along the bottom here because people are not really hiring. This is, again, Indeed.com job postings. And so people always tell me, they're like, well, Eric, how are you making such a call just from Indeed? And well, Indeed has a huge part of the market share. Whenever you're hiring for a professional job, you generally go to Indeed. But you also go to LinkedIn, and this is something I haven't shared in the past, and I just started looking at it a couple of months ago. This is LinkedIn's economic graph, and they started doing regional reports. So you can see here that it's just not good, right? I mean, this is a year over year. Go ahead. I'm sorry.
But what do these numbers mean? Like, so I see I see lines moving, but hiring rate.
Yeah. So if you look at it at the bottom, the hiring rate is the percentage of LinkedIn members who added a new employee to their profile. So is it perfect data? No. But I could argue that the data that we get from the BLS is imperfect as well. I think that we have to look at multiple data points whenever we look at employment data.
As that will tell you which direction the market's moving in. Like, are you going to put together a CMA based off of job reports? No, but it gives you that indicator of the health of the market and the direction the market should be heading in.
And I think, your point that this is imperfect is it's very relevant, and that's because it looks dismal, right? Like, this is only 12 months of data, but we were already down versus 2024 every month, and then it just shot very low in March, and it's been pretty low since then. But to summarize, jobs are not plentiful in Austin, and we are very used to having a job market with lots and lots of jobs, and it means a lot of people buying houses and selling houses because they're getting new jobs and they're moving up or they're moving away and they're moving in. And beyond mortgage rates, I think that's the easiest way to tell the story of why we are disproportionately affected by this downturn in Austin.
So, question for you about using jobs as a metric and using them at the local scale.
Yeah.
Part of what the pandemic did is it shifted to a much larger remote workforce where you could work from anywhere. How do those indicators that you're looking at for jobs, do they take that into account? Because is it, hey, remote work where the office is based out of Austin? Because a lot of Austin is tech, and a lot of tech is being done remotely right now.
Well, I mean, yeah. Well, sorry. There's a few things to address there. One, no, it doesn't. I mean, these are literally just the geolocation of where these jobs are being posted. So if it's a company the job is posted in Austin, it's in Austin. LinkedIn, it's going to have to do with where is that member profile. So again, imperfect. But whenever we're talking about remote work, I mean, one, I would point out that that's been part of this correction is the fact that, during the pandemic, leaders were saying that everyone's going to be able to work remotely 100% of the time forever. And then, since that time, I mean, that was kind of drunk talk in retrospect. You've heard the term RTO, right?
Yep.
Yeah. So everybody's RTOing. And I could argue that, if that were to skew one way or the other, it probably skews in our favor because of our RTO. Whole separate topic. I'm not here to debate whether or not people need to be in the office, but the trend is now that leaders in tech, in pretty much every industry, want people coming back to the office.
I hear that out of some of the large tech companies. I haven't dug into that enough. I have my suspicion when it comes to some tech sectors, but you are right that things are trending back in that direction, which would suggest that these numbers are becoming more and more reliable.
It's unknowable how reliable they are due to that variable. But anecdotally, most of the people we relocate in are relocating in for big companies. They're relocating in for Meta or for Apple. Google, all of these companies are RTOing, right? Dell, 100% RTO, right? It's another big company that brings people in. I want to stay on this topic though, because what you'll hear a lot of, and right now, whenever you read stories in the news, which I've stopped doing, I have a fun Replit app I'm going to put together that I'll tell you about after. But you hear a lot of, Austin boomed because everybody moved there because they could work remote, and now it's busting because people can't work remote, or they've figured out that it's really hot in the summertime. And I would strongly argue that that's not the case at all. Fact that physical presence in the office is often required is a benefit to Austin. That's why companies move their offices here is because it's much cheaper here than it is in the Bay Area or New York or Southern California. So when things get back to business as usual, whenever tech starts hiring again, we have all of the ingredients to start booming again. But right now it's not great. And another number to watch, or another, I guess, anecdotal evidence to watch as well, is like what's going on with office space. We have the office market, and don't quote me on this, but it's something like 20% vacant right now. And, you're going to see that start moving in a positive direction before jobs start coming back. I mean, if you think logically, you want to hire more people, we need to make sure that you have space for them. So anyways,
you keep a pretty close eye on this, and I'm racking my brains. I thought I heard that there was some pretty big announcement within the last month of an employer either expanding, someone in the tech sector either coming to Austin or expanding their presence here. Was there news around that?
Yeah, there are three things that I know of, right? And I try not to, obsessively watch this stuff, but yeah, so small. Zendesk is relocating here. That's not huge, 200 jobs, but that's great to see. It's a move that you see a lot of people make, right? Like, hey, it's more economical to be in Texas than it is where we currently are. We're going to make the move. Really hard to attract talent to Houston or San Antonio, tech talent at least. You can attract tech talent to Austin. Big news that Tesla announced a multi-billion-dollar deal with Samsung to build their AI chips. And I don't know for a fact that those will be built in Taylor, but it makes a lot of sense that they will be. And Samsung, succeeding helps our broader market. I think what's going to happen is you're going to have chips built in Taylor that are just being driven down to the Tesla plant near Bastrop. Third thing, and this is rumor, but there's a lot of people that are saying it's not rumor, is that Nvidia is taking a ton of space in the domain. And so that's, AI chips as well. And so what would be very good for Austin is if we continue to get more from not only just the tech sector, but from AI, which that's obviously the growth subsector of tech.
Yeah, the Nvidia one, jogging my memory, that's the one I think I heard as well.
Here's another one I would recommend you look up. Check out Ten's Torrent. They're down on Southwest Parkway, and that's an ex-Tesla exec that founded that company. And I mean, they're a multi-billion-dollar valuation now, and they are taking on Nvidia, or that's the plan. And I have a friend and past client who's on the executive team there, and yeah, they're crushing it. So if those guys continue to succeed, you'll see even more of a footprint for AI in the Austin metro.
Here's hoping.
Here's open. That's it, man. Let's start digging. Let's dig into the weeds on this. You love numbers, so like, what are the numbers you're looking at? Let's hear it, Aaron. Like, what do we care about?
Yeah. So the summary that I mentioned earlier on, I'm gonna share my screen and just kind of show you what I'm seeing here. So it is all about this right here. That from June to July.
Can you zoom in on that if you don't mind?
Typically, we see a drop off in the number of pendings.
Right.
Historically, we go down, call it 5% drop off, but we went up. We actually, like, a market indicator improved in Austin last month, which is fantastic. Like, so we went from, just shy of 2,700 pendings in June, and we went up to over 2,800 pending listings in July. Now, that is really encouraging. And when you start going across the different submarkets, you see it inside of resale. You don't see it inside of new construction. And this is where I think the telling part of the story is. The fact that new construction, it really is moving, although we're seeing more than historically average, but it's moving in parallel to what the historic average is month over month this year.
I think it's really great to compare resale and new builds, especially right now. And what I notice is just like how consistent it is. And that has to be manufactured, right? Like there is just less demand in the market in, for example, the holidays than there is in March. So just like car dealers, right? Toyotathon event, they have their own versions of that where they tend to offer better incentives in the wintertime. And it looks to me like they're doing a pretty good job of creating sort of a level number of contracts. Would you agree with that?
Yeah. Actually, that is an interesting point, because if you look at the number that go pending, it's far flatter than, you know, the seasonality. There's far less seasonality that we're looking at here. But if you were to look at seasonality, it looks a little bit more U-shaped, which is the inverse of what you see inside of the resale market. You know, demand has been suppressed here for a while. That it has been a rough road since the beginning of since the beginning of last year for a while. Now, that said, you got to get something under contract now if you want to be in there for the new school year.
Yep.
And my guess is that what's really occurred has to do with buyers that have been very cautious all summer long, waiting to find that perfect home, that there was actually pent-up demand that we're seeing expressed.
Got it.
And that pent-up demand was just waiting to see what's going to happen on mortgage rates, waiting to, hopefully to see the market stabilize, and just come July, like, well, we got to buy something now so we can be in there for the new school year.
And that's that's kind of what we've been hoping will finally hit. I agree with you. I don't think that en masse sellers decided to become reasonable in the month of July 2025. Like everybody decided, oh wait, let's start selling our houses. So that could certainly explain it. I'm very interested to see how much the lower rates will affect the month of August. And I haven't looked at the numbers yet. I probably will do it today because I can look at 50% of August so far. My gut is that it impacted it. I'm usually surprised at how much dropped rate. I'm usually surprised at how much rates dropping impacts pending units. So hopefully we'll see some more positive numbers in the month of August.
Can you catch us up a bit of what happened with rates last month?
Yeah, sure. So sharing screen, here's rates from January 1st to present. And, I actually had Mortgage News Daily pulled up in another tab, and I'll show you that. So, here are rates from March 1st, 25 to present. So let me get some of this noise out of here. And, you can see that right here, rates. Oh, that's when it happened. I'm sorry. It was July 31st. So it was after the Bureau of Labor Statistics jobs report came out. Rates just started dropping, and then they settled in the 6.5s. Right? They've gone back up above 6.6 a little bit. Today they're at 6.52, and so not quite a half a point drop in mortgage rates. That's half a point drop in mortgage rates is significant. Like that will get people off of the fence.
That didn't happen till July was done. So
Right.
It'll be real interesting to see like where, next month is going to be an interesting conversation, right? Because we're going to have a better understanding of what happened in July based off of median sales price that are closing out in August. And then that pending number for August, was there more pent-up demand, and that the drop in mortgage rates really spurred contracts, or did we catch up? Did the market catch up to the amount of demand in there?
It's anybody's guess, right? And August is an historically slower month in pendings. It's just kind of a straight line from, call it April, May to the next spring, really. But yeah, it'll be interesting to see. I would guess that more people will get off the fence, but when you're getting the kids back to school, it's not a great time to go house shopping, so it might have less of an impact. I will say that if the rates stay where they are, if they stay in the mid sixes, and it'd be amazing if they came down a little bit more, I do know that people will shop in the fall before the holidays hit. So last year, actually, the fall of 2024 outperformed 2023, and it kind of saved 2024. We'd had a pretty dog year for the entire year, and then the fall came along, it outperformed, and we ended up like almost flat with 2023. I'll show volume in a few and show kind of what's happened year to date with volumes down, and I'm hopeful that we can have a fall that will sort of pull that back up, and maybe 2025 ends the year a little bit better than we thought it was going to. But very interestingly, prices are just not going anywhere. They're almost completely flat, and I can show you a chart on that if you'd like to see that.
So it's interesting that you say that prices are flat, because yes, and like they've been flat for the last, well, geez, since there hasn't, let me pull this up because I was looking at prices that I do agree relatively flat, but still down over last year this time.
So show me what you're seeing on prices.
Yeah. So I'm looking at median sales price.
Yeah.
And let me just share my screen. This won't be the most fascinating screen share. But when you look at, and we're comparing this last 12 months to the 12 months prior, and we look at median sales price.
Can you zoom in there?
Yeah. We're down 10K.
Go to average.
Average sales price.
Yeah. So you're barely up, right?
Yeah. Average is staying right in,
Right. And then, so this is, I know this is one of the reasons why I like to show this in percentages is, give me one sec, man.
Let's talk about it. Like median sales price has, home values have depreciated by 2.4%.
Year over year. Yeah.
Yeah.
Oh, well, let me show you a couple. Let me show you a couple of other ways to look at this. So we look at things, on a year over year basis, and we do look at the months. But I'm not the biggest fan of looking at things monthly if you're looking at market trends. And that's because you can make decisions based off of 1 month. And I always say 1 month doesn't make a trend. So you have exactly the same numbers, right? So we have an average sold price went up 0.9%. Median sold price went down 2.5%. Average sold price per square foot minus 3%. Median sold price per square foot minus 4.4%. So not big numbers, right? And if I had to summarize July, I'd be like, yeah, the pricing went down just a little bit. But whenever I say prices are flat, let me show you what a 24-month chart looks like. This is average and median sold price from July. It's from July of 2023. So it's 25 months actually. And you can see they look like Kansas. They're as flat as they can possibly be. But from, from July of 2023 to present, we have just the slightest ever uptick on average sold price. You just have the slightest down on median sold price. Very, very minimal. And then whenever you look at the monthly fluctuations, sure, it goes up, it goes down, but you can't time the market. Like a mistake that a lot of sellers make and a mistake that a lot of buyers make is that they try to treat the real estate market like the stock market. And, okay, when's the best time to buy? Oh, there's fear in the stock market, let's go buy. I'm going to wait a week, things like that. And with real estate, you just can't do it. Are you going to sell this year? Generally the question. Are you going to buy this year? Are you going to sell next year? Are you going to buy next year? Whenever I bought a lot of houses, I always knew that if I bought in the fall and winter, that I would have an edge because you're buying it during that seasonal dip. But trying to time it, this month versus the next month, I don't think is a very strong strategy. But looking at it from a zoomed out 24-month perspective, would you agree? Like when I say it's flat, that's what I'm talking about.
Yeah, that graph shows it as being absolutely flat.
What would be interesting, what we ought to do is go back to 2020, like that same chart that I have for the Indeed jobs. Mm-hmm. I'd love to go back to 2020, January 2020. And actually, the chart I showed was 2022, but go back to 2020, watch prices go like this, and then like this, and then they just kind of go like that. Now my finger went off the screen, but big rise, like 40%, then it drop of like 20% in about 6 months time, which is insane. We've never seen anything like it. And then it just sort of like flatlines from there is the way that it looks. Another number that I will campaign to you, that I will pitch to you is, it's success rate. So that, man, we have it in our platform, right? We know the success rate of any given zip code. And historically, the success rate is 85 to 90%. That's just where it is. And it's about 65% in most zips right now. And what that means is that 2 out of 3 sellers are successful, meaning 1 out of 3 sellers are just not selling and they are pulling off of the market rather than go down in price. So the story that explains it is these sellers are not that motivated because they have a locked in, very low interest rate and they have options. So if I can't get my perceived value is not what the market says it is, don't care, pulling it off the market. I'm going to live in the house. I'm going to rent the house out, or I'm going to let the house sit vacant. We've literally had people just let houses sit vacant rather than sell it at a reduced price. What else? What other charts do you have for me? What do you want to? Do you want to show us?
So I've been looking at some of the submarkets, and gonna pull up months of inventory across the different zip codes. And this is for basically how the average months of inventory over the last 12 months has been comparative at the zip code level. Basically, where's hot and where's not. And looking at this, some interesting things as I started just digging in. First is that it is noteworthy that, close to this, the center of downtown, where homes are the most expensive, has had the roughest time. It's been just super slow there. There's been a lot of inventory. If you're looking at 03, you're at 7 months of inventory. Now, this is the average of the last 12 months. I take a longer view when you get into the map than when we drill into any one, but it has been a much slower market in 03. 01, of course, the luxury condo market has been horrible. 14.8 on average over the last 12 months. Now, some interesting things. One is that there appears to be roughly, I'm going to say 3 different just circles around Austin. You have that core downtown area that it's been really slow in. And then you have this center circle, this circle around downtown that's been really healthy, that we've been seeing inventory moving at a great clip. And then you have the periphery where things slow down again. And that's not surprising, right? Typically when you go into out into the country, things take longer to sell. But it is interesting that we've got really slow, pretty hot, and then it goes back to slow again.
What I would be interested in comparing is doing an all city of Austin 1.5 million plus to see what the MOI looks like on that. My intuition is that there's not a lot of entry level priced anything in 78703, but my gut is that it's a price point issue more than it is a location issue. But yeah, that is super interesting. And then what I notice also is 78758, 78759. Those are doing really well. What's the MOI in 5.8 right now?
5.9 is 3.45.
I mean, that's a seller's market. It might not behave like one, but that is. Yeah.
Now, what I was looking at that I wanted to share is what's going on in East Austin, which is that depending on what part of East Austin, it is a tale of 2 cities. 02 has been slow. Over the last 12 months, 8.5 months of inventory. But then you go up into 2.2 and 2.3, and I'm going to look at 2.3. You're at 4.8, you are balanced to the side of it being a seller's market. Now, when we kind of start looking through that and look at how pendings went, 02, it's been, the demand has been far below average for these last 2 months. And this uplift that the rest of the metro market saw, 02 did not see at all.
Right.
It was just flat as could be from June and July. They've got a ton of inventory, and there was a healthy amount of demand the first part of the season. It almost looks like there'd been no pent-up demand, but the bottom fell out back in June.
Sorry to get you off your game, but can you compare that to 04?
Yeah, no problem. So in 04, 04 has just been flat the whole way through. Sad story.
Yeah. But 02 has 9 months of inventory. And you can see the demand dropped in July. Where are we at MOI in 04?
In 04, about 9 months of inventory.
Can you scroll down? Just humor me. What's the median price there in 04?
Median sales price is $884. Yeah.
So what I noticed, and I know this intuitively, from priciest to least to cheapest, 04 is the most expensive, then 02, then 23, then actually 22 is going to be about 23. 22 might be a little bit more. But I did notice that 02, the median price was just under 700,000. And then whenever you go into 23, it was 580. So I don't know. I mean, I don't want to keep hammering on, it's always price. But the rule of thumb has always been that when a market recovers, the Austin market recovers, it recovers from the bottom up, inside out. And so I think that rings true. And I would love to talk about resale versus new construction in just a minute. But that, in my opinion, the new construction market is what causes the suburbs and exurbs to recover.
Let me throw this curveball at you. The luxury market, now I'm talking about $1 million up, not $1.5 million up. It went up in July as well.
Okay.
Like, it mapped to it was just as strong, if not stronger, than what the pending uplift was for the entire Austin metro. The luxury market did very strong last month as well. So I'm not sure, I'm not sure that the improvements that we saw in demand last month are necessarily mapped to just saying like, hey, the market's getting better, period.
Right. No,
Now,
that makes
going
sense.
back to 2-3 real quick, I did want to, there were just a few markets I wanted to show because right next to each other and looking at that. In a market that, where we saw a lot of uplift last month, 2-3, we saw an exceptional amount of uplift. So we went from 25 to 30, something close to like 30% more pending listings than the month prior, which is just a remarkable lift.
Right.
You start looking more in that area, and I'm going to go over to Mueller now. Smaller numbers, so there's more variation.
Right.
But whoo, that was a rocket ship. So in June, only 2 things went pending, and then you go to July, 15 things went under contract in Mueller. When you want to talk about what buyers and sellers inside of Mueller experienced last month, if you were a buyer in Mueller and you were looking for something, all of a sudden, like all this stuff you were interested in is no longer available. And if you were a seller and yours wasn't going under contract, you're then scratching your head saying, what do I need to be doing differently? When it comes to what people in Mueller were experiencing last month, it was remarkable. Now, getting even smaller numbers, and this is the other neighborhood that had just a remarkable month last month. Again, numbers are smaller, but the impact is significant. Brier Woods. So again, the number going pending here, this is an interesting, 3 went pending and the month prior it was 0. So those numbers are very small.
Right.
The supply though, that was remarkable where in June, there were about 11 active listings. Come July, your options were cut in half. There were only 5. And again, small numbers don't offer you predictive value, but if you're shopping inside of Brier Woods right now, your options got cut in half between June and July. And so there's just some remarkable shifts in some of the neighborhoods that occurred. If you've got one of those 5 listings left in Brier, you've now got fuel to be like, all right, time to shit or get off the pot.
Yeah, I would agree. I would agree with that. Did you want to point out any other neighborhoods at all?
Those were the ones that I found to be the most remarkable, which was really the zip code level differences going on in East Austin. Which, yeah, I agree that's large. Like a large part of that is median home price. Like you could say 4 and 4.5, look at something similar. The just flurry of activity that occurred in Mueller and how much came off the market in Brier last month were probably some of the biggest movers that I saw.
Got it. Can I talk about resale and new construction for a minute?
Please do, yeah.
I started looking at this whenever I wanted to explain what do we experience as agents, the folks that we help. So, roughly 20% of the sales in the MLS are new construction, and when you strip those out, you get a clearer picture of what we're dealing with. These are resales. These are what the decisions home sellers are making. It's not, investors, new builds for the most part. And so I just compared year over year change, right? And the total sales they dropped last month. So I know you and I've talked a lot about how last month was a great month, and I agree with you. What we didn't talk about was that total sales were not great. All of MLS dropped by 4.1%. Resale dropped by 8.3%. Total under contract and pending in all of MLS went up by 9.1%. Yeah, went up by 1.8%. So it looked like a lot of the under contract pending movement was in the new build sector. Average days on market, resale went up by almost 21%. I think it's probably like 60 to 70 days, something like that. And then all MLS went up by 12%. Here's what's really interesting is the average and median sold price. So while resale is underperforming on a volume perspective, pricing is actually going up a bit. So average sold price went up by 4.5% on resale. Whenever in all of MLS it only went up by 0.9%. Median sold price went up by 2.4%, while all MLS went down by 2.5%. And it's all just really interesting to me because it's not dramatically different, but it is different. And so what it tells me is just simply that our home sellers are they're pretty stuck on price, right? Like they're not really willing to come down to meet a lot of buyers where the buyers want to be. One more point on new construction, and this is a chart that I didn't put together, but this is a chart that Lennar published, and this shows you the percentage of sales incentives on every home they sell since 2009. And they are offering 13.3% in incentives on every home they sell today. And you can see that like at the bottom in 2022 is 1.5%. So the average, I believe, is somewhere around 6 or 7 if you were to average all of this out. And what the takeaway for me is that, man, if you're in a neighborhood where builders are still building, or if you're near one, then you have some really stiff competition. If one, you're competing against new construction. So your home is a used home, for lack of a better word, if people are looking at new and resale. So new is nice. Like you move in, you're the first person to live there. The carpet smells, everything, is nice about it. So that's your very obvious obstacle you have to overcome. The second is if this builder is offering the home for, $600,000, they have an additional $18,000, like an additional 6% that they've baked into this. And I always used to say that rate buy downs are really effective for builders and they don't seem to work for resale, and I never knew why. So I don't know why. It just is. Whenever we see sellers try to offer rate buy downs, like resale sellers, it just doesn't work. And for some reason it moves the needle with new construction. And this tells me all I need to know. It's because a resale seller is going to offer a rate buy down in the way of like, hey, I'll give you 1%, I'll give you 2% maybe. Whereas the home builders are saying like, listen, we'll give you, we're going to get your rate bought down to 4%, meaning we're going to pay 6, 7, 8% to get the rate bought down. So it's just tough. I mean, the takeaway is you have some stiff competition if you are in or near a neighborhood that still has an active builder in that neighborhood.
If you have a seller or a prospect that is near one of these new construction places, done. Buyers pay for done. They don't want the project of, we just decided to leave that bedroom purple, that way they could choose whatever color that the buyer wanted. Paint that thing white. Take the time to do it, spend the money to do it, because buyers don't have any work with that new construction. Sure, there's like the punch list and stuff, but they don't see that. Like when they show up to that resale, they see work.
I would agree with you wholeheartedly. Craig McGuire is one of our top listing agents. He said, "Oh man, if the sellers are serious, then we're not leaving anything alone." He said, "Oh, there's roof repairs, like we're putting a new roof on. We're not touching up paint. We're repainting the interior." And exactly what you said, that they want done. They want a finished product. If you have a lot to choose from, if you're on the fence on whether or not you're going to buy or not, man, I mean, you don't need any reason to not buy this, to not buy this house. Like there shouldn't be any excuse to move on to the next. So yeah, agree with you completely. On the other end of it, the market for distressed properties right now is about as close to zero as it can get. Right, owner-occupant buyers, they just have no appetite to change anything these days. And the investors that are out there, they better get a dang good deal. Like they're looking for fire sales because there's not very many investors out there. So agree with you 1,000%. on that observation.
Yeah, I mean, so when it comes down to it, July was a very just anomalous month where things didn't go how they typically would. Things went better than expected. And I think that it's going to be really interesting once we, in September, when we're looking at August numbers, where we see, all right, how did the median sales price shift? How much was it sellers that were really coming off their price versus that buyer pent-up demand? And then also seeing that pending number for August and seeing how interest rates really affected demand in what is historically a very slow month.
I mean, if you have any takeaways for like the agents out there, what do you do? What do you do right now?
Congrats. That's really the takeaway. We needed a break and you finally got one. It was called July.
Right.
Which is really to say that, hey, things got a little busy again. Now is the time to not forget the marketing, your SOI reach out. Otherwise, all of a sudden, the end of the year is going to be a lot slower than it should be.
Yeah, no, I think so. I mean, going into the slower months, you can't forget. I mean, I don't want anybody to misinterpret this good July as like, oh, wow, the market is turned around. Oh, we're going to have a screaming September, October, November, December. That just doesn't happen. So it's important to remember that these are the months that you business plan. These are the months that you put together real estate reviews if you're a ninja. These are the months that you build pipeline. So even though your open houses are probably slower, you still want to host those to meet new buyers. If you work leads, take a bunch of leads, but just understand that you're probably not closing them in the fall. And with all of that sort of like under promising, hopefully the market over delivers a bit and you end up selling some homes this fall and winter. That would be my takeaway from a strategy perspective. Well, thanks for coming. And I look forward to doing this. Aaron and I are going to start doing these every month. So, thank you everybody if you made it this far. We really appreciate you watching. If you need to get a hold of Aaron, he's at agentintel.co, or you can Google Aaron Scrugs, that's Cruggs. You guys know how to get a hold of me. You can drop a comment. You can go to our website. If anybody has any questions over the market or would like to discuss strategy, I know that I would love to chat with you, and I know, Aaron, that you would also like to chat with them.
Yeah, absolutely.